Let's move on to a new topic: asset-backed securities. Asset-backed securities are fixed income instruments created through a process known as securitization. In this lesson, we shall understand how the securitization process works. We first discuss the benefits of securitization, followed by an example of a hypothetical securitization process. We examine the parties involved in the securitization process and end off with an introduction on how asset-backed securities are structured. Let's get started. Securitization refers to a process by which ownership of assets is transferred from the original owners into a separate legal entity, known as the Special Purpose Entity or Vehicle. The SPV then issues securities backed by these assets and sells them to investors. The proceeds of the sale are passed on to the originating company as payment for the assets. The assets' cash flows are used to pay both the interest and principal owed to the investors. These securities are generically referred to as asset-backed securities. The pool of securitized assets is called the collateral. These assets are typically loans and receivables such as mortgages, automobile loans, student loans, bank loans, accounts receivables, and credit card receivables. So, what are the benefits of securitization for economies and financial markets? Consider mortgage loans. Traditionally, such loans are originated by banks. Without securitization, if an investor wishes to gain exposure to these loans, they can place a deposit with the bank or invest in the bank's debt or equity securities. None of these is ideal. Firstly, the bank is an additional intermediary between the investors and borrowers. This adds to costs to be borne by the investors, thus reducing the returns to investors. Moreover, deposit rates are too low, and holding securities issued by the bank exposes them to much more risks than just the mortgage component. Compared to this traditional structure where the bank serves as the intermediary between borrowers and investors, securitization can provide the following benefits. Firstly, the bank is no longer the intermediary, so intermediation costs are reduced. This results in lower funding costs for borrowers and higher risk-adjusted returns for investors. As the special purpose vehicles are separate legal entities from the bank, the investor's legal claim to the mortgage loans is stronger as they are marked as collaterals for the ABS. Without securitization, investors only have a general claim against the bank's overall assets. Thirdly, when a bank securitizes its loans, the securities are actively traded, which increases the liquidity of the bank's assets compared to holding the loans on the bank's balance sheet. Moreover, with the cash proceeds from the sale of the ABS, banks are able to lend more. And as there are many borrowers in the mortgage pool, there are diversification and risk reduction benefits as compared to whole loans where risk is concentrated on just a single counterparty. As we'll learn later, securitization can lead to financial innovation that allows investors to invest in securities that better match their preferred risk, maturity, and return characteristics. The securities can be structured into different tranches with varying levels of risk versus returns and different terms to maturity. In most securitization transactions, there are three parties involved: the seller, the issuer or trust, and the servicer. We shall illustrate a typical securitization transaction and the parties involved with a fictitious example. Credit Drive is an automobile dealer that sells most of its cars on credit. The customers buy the cars and enter into loan agreements with Credit Drive to pay for the cars. The autos are marked as collateral, and Credit Drive receives principal and interest payments on the loans until they mature. The loans have maturities of 48 to 60 months at various interest rates. Credit Drive has appointed Credit Collect as the servicer of the loans. It collects the payments on behalf of Credit Drive, sends out delinquency notices, and repossesses and disposes of the autos if the customers do not make timely payments. In order to fund its business expansion plan, Credit Drive has decided to securitize $100 million of its loan assets. It accomplishes this by selling the loan portfolio to a special purpose vehicle called CD Loan Trust for $100 million. The SPV is a separate legal entity which is set up for the specific purpose of buying these auto loans and selling asset-backed securities with these loans as collaterals to investors. It's referred to as the trust or the issuer. So the investors pay $100 million as principal for the ABS, and the $100 million is in turn paid to Credit Drive for its expansion plans. The loan servicer is still Credit Collect. Credit Collect collects payments from the borrowers and passes on the payments to CD Loan Trust. CD Loan Trust appropriates the cash flow to its various investors. Let's review the parties to this transaction and their functions. The seller, Credit Drive, originates the auto loans and sells the portfolio of loans to CD Loan Trust. CD Loan Trust is the issuer or trust in this case. It is the SPV that buys the loans from the seller and issues ABS to investors. The servicer of the loans is Credit Collect. It collects the payments and passes them on to the SPV. The SPV disperses the cash flows to the investors. Do note that the seller and servicer do not have to be separate entities. In some arrangements, the seller can be the servicer as well. Let's dwell a bit more on the special purpose vehicle. You may be wondering why Credit Drive can't achieve the same outcome by retaining the auto loans in its balance sheet and just setting it aside as collateral for a corporate bond issue to investors. The primary reason has to do with funding costs. If Credit Drive as a company has poor credit ratings, the corporate bonds that it issues may have high interest costs, no matter the quality of the collateral placed. By selling the underlying assets to a separate entity, the assets are protected from the creditors of the originating company. With the ABS structure, the claims of the ABS holders to the cash flows from the auto loans are not affected by the financial position of Credit Drive or its bond rating. CD Loan Trust is bankruptcy remote from Credit Drive. Such a structure allows the creditworthiness of the ABS to be evaluated on the quality of the collaterals and cash flows, not affected by the creditworthiness of the originating company. If the credit rating of the collateral is good, this can result in effectively lower funding costs paid by Credit Drive on these ABS. Besides bankruptcy remoteness, another way to improve the creditworthiness of the ABS is by tranching. This is to segregate the issue into multiple classes of securities, each with a different claim to the cash flows of the collateral. With this structure, a particular risk of the ABS securities is redistributed across the tranches. Some bear more of the risk and others bear less of the risk. The total risk is unchanged, simply reapportioned. There are two forms of tranching: credit tranching and time tranching. Time tranching will be reviewed later in the lesson on mortgage-backed securities, so we'll focus on credit tranching here. With credit tranching, the ABS is segregated into senior and subordinated tranches. This is known as a senior subordinated structure. The seniority of a tranche determines its exposure to the risk of default of the underlying assets. The subordinated tranches absorb credit losses as they occur up to their principal values. Using CD Loan Trust as an example, the $100 million ABS issue can be segregated into the following bond classes: senior tranche with a capital amount of $70 million, subordinated tranche A with a principal amount of $20 million, and subordinated tranche B with a principal amount of $10 million. In the event of a credit default, the recovered amount is used to pay off the principal for the tranches in the order of their seniority. So, for example, if $85 million was recovered from the liquidation of the collaterals, the first $70 million goes to fulfill the obligations to the senior tranche holders, followed by the remaining $15 million to the subordinated tranche A holders. It is insufficient to fulfill the entire obligation, so the tranche A holders absorb a $5 million loss. As there is no remaining amount to pay tranche B holders, they absorb the remaining $10 million loss. Because of such a structure where the most junior tranches absorb the losses first, tranche B will have the lowest credit rating and offer the highest yield of the three bond classes. This structure is also called a waterfall structure because in liquidation, each subordinated tranche would receive only the overflow from the more senior tranches. And that concludes this lesson on the securitization process, where we also discussed the benefits of securitization. In our next lesson, we shall examine in detail the most common type of asset-backed securities, mortgage-backed securities. See you soon.